Hello everyone, I am Alex Leonida and I am the portfolio manager here at Capital Financial Group, and I just wanted to give you a warm welcome to our quarterly outlook video for Q3 2021. Nearly all risk assets have performed admirably this year. We're seeing a few warning signs on the horizon, but aside from a bit of a performance divergence, gains have been ubiquitous. I'm going to dig into this a little bit over the next 10 minutes or so, and I'm also going to discuss why our bullishness has quickly transitioned to a bit of, maybe not so bullish. Anyway, let's rock and roll. Let's get this party started. What's happening in global markets? Each one of these videos has kind of a little bit of a different flow to it, and we are taking client feedback and viewer feedback, condensing this just a little bit more so you guys can actually make it to the end of the video. Let's jump right in. U.S. stocks have had another banner start to the year. This chart right here breaks down S&P, NASDAQ, and then Russell 2000. If you guys are clients, then you know what all of those are. But basically, NASDAQ is tech, S&P is big companies, and Russell 2000 is small companies. We were talking about small caps being just crazy, going through the roof with all the meme stocks and all of that stuff earlier in the year. Large caps have caught smaller companies over the last couple of months, and frankly, investors have been slow to adjust. This is not something really to worry about. However, it is important to note the shift back to relatively safer risk assets, i.e. large caps, kind of happening at a big scale right now. In terms of data, most of the inputs that we like to follow on a regular basis are showing symptoms of peaking from a rate of change standpoint, and small caps are more closely tied to a lot of those growth numbers. So that's why we've seen them kind of stagnate over the last few months. If you want to get into the weeds on this, shoot me an email at info@cfgfinancialplanning.com. I'd be happy to unpack the topic further. After numerous fits and starts, Developed International is starting to trend, which isn't, I guess, saying all that much, but the whole point of this video is where are we going from here, right? They just continue to disappoint us. Mostly it's a leadership issue. The Eurozone in general has been locked down significantly more than the United States. I guess is the nicest way to put it. France just opened a couple of weeks ago. People were still forced to sit on their couches and do nothing. Couldn't work, couldn't spend money, whole 9 yards. But in any event, we think that pin-up demand is going to come home to roost, and we're going to see a little bit of bump in terms of rate of change and all of the big data inputs that we like to follow. So we think that there's some room to run into the late fall for internationals. Emerging markets still have all of the tailwinds that they're looking for, but the general drama surrounding COVID over there, the different variants, Asian countries make up a large portion of the emerging markets index, and one of the issues that we have a tendency to see with them is they've had so many different epidemics over the years that there is almost a sense of panic every time there's a new variant of this COVID, which has made it really hard for them to kind of get their feet underneath them, recovering from this terrible disease. And then also China is kind of messing up Southeast Asia right now. A lot of aggression going on there, a lot of uncertainty there, and markets don't like uncertainty. Everything is still set up for emerging markets to outperform, but as you can see from this chart, they've really lagged the last few months, like I said, for that aforementioned drama, for lack of a better term. Moving on, the weak dollar realistically should have given the EM a little bit more of a boost, but their leadership just can't really get out of their own way. I don't know what else to say. Moving over to fixed income, bonds, if you will. They were laggards for most of the year. We talked about this in the last video. This wasn't really unexpected. Generally speaking, yields have kind of normalized, right? Nobody was expecting the 10-year treasury to be sitting around at a 0.5% yield forever. That's not really a normal thing. I guess it is in Japan and Europe, but not here in the United States. So right now with yields peaking out around 175 basis points or 1.75% on the 10-year. Treasuries are starting to look interesting as there's been a bit of a trend reversal. Everybody was freaked out about inflation, etc. We've seen the bond market, treasuries in particular, telling us that there's something else going on there. So we are starting to take a hard look at this asset class because it hasn't been part of our asset allocation for quite some time. And we are looking to move back into high quality corporate debt and then also treasuries at some point here in the next few months. We definitely see some relative value with this trade, even if there's no real home runs set up in treasuries. One of the first rules of making money is not losing money, and if treasuries are going to help buffer portfolios, then we will look there without batting an eye. Let's talk about kind of what policy looks like in Washington, because that's driving a lot of market conditions right now and has so far this entire year. Things have changed a little bit. The Biden administration is throwing some mixed signals at the moment. This is probably not entirely shocking to everybody, considering the platform that he ran on was to save the U.S. from COVID, right? And COVID hasn't really been an economic problem, at least since last summer. So that makes the whole infinite spending plan, the bazookas of money falling out of helicopters that we've talked about in the last few videos. It kind of makes that whole plan hard to sell, really. And beyond that, the tax increase that was allegedly almost done about a month ago has hit a bit of a snag. There's a lot of reasons why. Generally getting tax hikes through Congress isn't always that easy, especially with Congress being split so evenly. But mostly just voters don't really want higher taxes. Even if they go out on their soapboxes in public and say they don't care about taxes or they want to be taxed more, I think we all know that that's probably not true. But hey, just speculation. I'm not in their brains. Basically, what we're going to go for here is a massive increase in capital gains taxes, estate taxes, income taxes across the board. Can't possibly be good for the economy. It's just not a real thing. I am definitely sympathetic that the budget is completely out of control. But realistically, just from my own personal perspective, I think we should start at the budget and not juice taxes all the way across the board for everybody. And don't believe what you hear. It's not just on the super rich. It's literally going to affect everybody because it always does. All right. So let's talk about the Fed a little bit. They've waffled kind of in their policy and their discussions over the last couple of meetings. They can't really decide what's an acceptable amount of inflation, what's not an acceptable amount of inflation. I'd argue that inflation's probably actually just going to work itself out, like open free markets have a tendency to do. Prices have gotten absolutely bananas on certain things. If you remember the charts from the last quarterly video, if you haven't watched it, go check it out. It's pretty good stuff. All you have to do is look at wood, right? It's working itself out. It's cut in half. That's just kind of the way that things go sometimes. If we see corn and soybeans go through the roof again, people are going to stop buying them. When coffee prices go through the roof, people don't buy as expensive of coffee. There ends up being issues. There's always a scenario where you might end up with an oversupply because people are trying to get greedy on the supply side of things. The market's going to work itself out, so I wouldn't stress about inflation too much. And like I kind of alluded to earlier when talking about yields have started to back off a little bit. They've come down in bonds, and that's generally not an inflationary forward-looking thing. That's actually kind of speaking towards potential disinflation or deflation creeping into the market, which we're kind of on board with at this point. So let's move into our current positioning. This is my favorite part. We're going to mix it up just a little bit, try to make it a little bit easier to understand. We're going to talk about green lights, yellow lights, and red lights. They're going to signify increasing, maintaining, and decreasing exposure to respective asset classes. And as a great philosopher once said, all right, let's get going. We're going to go green lights first because let's start with the good stuff. Green lights are international stocks, quality fixed income, treasuries potentially. Not exciting, but green light. And then also precious metals, not something you hear me talk about all that much. Ironically, precious metals have a tendency to act as a deflation hedge, contrary to popular belief. If you don't believe me, give me a call. We can talk about it. Yellow lights are emerging markets for the things that I kind of alluded to earlier. There's some drama in EM, but ultimately the dollar has gotten to a point where it's relatively stable, but it's still weak in the grand scheme of things. And this gives an opportunity for EM to outperform if they can get their act together. Mostly, like I said, it's a leadership issue over there. Well, I guess not over there. It's over there, down there, around there, whatever. But there's still opportunity there, and they are historically cheap relative to developed markets, especially the U.S. market. So yellow light, verging on green light. There's just too many geopolitical risks there. Red lights for the year will likely be select parts of the U.S. stock market and commodities. Commodities ran too far too fast, and demand slipping due to extreme pricing. Like I said, this was a wood thing. Best example I can show you guys. The U.S. is slowing just a little bit in terms of growth. It's also slowing in terms of PMI. Inflation data is definitely rolling over, so we're going to kind of stay out of the way in terms of commodities. Remember, for us, the core principle is that data dictates our positioning at all times. We reserve the right to change our minds. We don't know what the data is going to be before it comes out. We have a decent guess most of the time. But as data changes, we're going to change the portfolio positioning. We're going to get clients set up for success in the best possible way that we can, and that's with all of the research that we do. If you guys would like to chat about this or schedule a review, reach out at info@cfgfinancialplanning.com. I love doing these videos. Thank you so much for making it to the end. I tried to tighten it up just a little bit for you guys. And I hope you all have a absolutely fantastic rest of your summer. And remember, hope is not an investment strategy.